What is a cap rate and what is its typical use in the market environment for researchers and market participants? Arithmetically speaking, a cap rate is simply income divided by the transaction price. What kind of measure of income? Usually, as a rule of thumb, it would be 1 year's worth of income as thrown off by a commercial property divided by the sale price that's most recently available, so that you could link it to the income that was being earned at the time. Now, where are cap rates typically used? It's typically used to value buildings. Say you're on the street and you want to go and say, how much is this building worth if it's throwing off $100,000 of income? Well, if we know that cap rates around the area for this kind of buildings would be 10%, you simply divide $100,000 of that income that you researched by 10%, and you have a number that says a fair price for this property would be $1 million. In a very real sense, it is similar to the price-earnings ratio that stock analysts sometimes use to value companies in the equity and or debt space. Now, there are different kinds of cap rates depending on which perspective you take. If you were the seller of the property, you would like to argue for a lower cap rate because that would typically imply a higher selling price. If you were the buyer of said property, you would actually probably typically gather data that suggests that the cap rate for this specific building ought to be higher because that would suggest a more favorable, i.e. lower selling price or buying price for you. Now, what is the real cap rate? Well, that question really can't be settled until you have a multitude of data points and perspectives that you can use in practice, which is why Reis offers at least 3 different kinds of cap rates in its modules. First, you've got the pro forma cap rate in case you don't have the income information for specific buildings. Reis takes a look at its 35, 36 years worth of history for specific commercial properties, office, apartment, retail, industrial, and reconstructs a typical income flow for a property given our data on rents, occupancies, and expenses, giving you an estimate of how much income this property would throw off. That would give you the numerator of said cap rates, and once you divide that by the transaction price, which is typically publicly available in most transactions, then you've got a cap rate pro forma for this specific property. If there is a reported cap rate, reported either by the buyer or seller, you can also see that in our sales comps data, although again, our caveat there would be, is it from the seller's perspective or from the buyer's perspective? To get around that too, what you'd want to do is take a look at cap rates over time or trends over time. Is it 6% or 7%? Well, what is the mean cap rate for the entire year? Is it trending upwards or downwards? We'll take a look at the 12-month rolling cap rate to smooth out any outliers, because you might not want to include that marquee property that transacted for a really low cap rate or a super high price, or that obsolete property that transacted for an obscenely low price, because it's at both ends of the spectrum. With that in mind, given the different kinds of cap rates available, we believe that the Reis module via transaction analytics via sales comps allows you to do both a high-level analysis of where cap rates are going over time, as well as go into specific transactions and really analyze what the appropriate cap rate ought to be for the specific deal you have in mind.